Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi. Perkenalkan, nama saya Sindeliana Putri dan rekan saya Nurmiatun. Kami dari kelompok 1 ingin membacakan hasil presentasi tentang current liabilities and payroll accounting. Oke, langsung saja kita simak videonya. Definition current liabilities and payroll accounting. Current liabilities are liabilities that will be paid using current asset and must be paid immediately within 1 year. Some example of current liabilities: 1. Accounts payable. 2. Notes payable. 3. Current maturity of long-term debt. 4. Short-term liabilities that are expected to be refunded. 5. Dividends payable. 6. Customer advance and refundable deposit. 7. Income received and advance. 8. Sales tax payable. 9. Income tax payable. 10. Obligation relating to employees. And payroll accounting is designed so that companies can pay employees' salaries on a regular basis and to provide useful debt for decision-making purpose by management. So, in this chapter, we will discuss what is in the table below: current liabilities and payroll accounting. Accounting for current liabilities: notes payable, sales taxes payable, unit refunds, current maturities of long-term debt, statement presentation and analysis. Contingent liabilities: recording, disclosure. Payroll accounting: determining payroll, recording payroll, employer payroll taxes, filing and remitting payroll taxes, internal control for payroll. Accounting for current liabilities. A current liability is a debt with two key features. 1. The company reasonably expects to pay the debt for existing current asset or through the creation of other current liabilities. 2. The company will pay the debt within 1 year or the operating cycle, whichever is long. Debts that do not meet both criteria are classified as long-term liabilities. 1. Notes payable. Companies record obligation in the form of written notes as notes payable. 2. Sales taxes payable. As a consumer, you know that many of the products you purchase at retail store are subject to sales taxes. 3. Unit refunds. How does a company calculate the upfront income received before the goods are delivered or the service is rendered? 4. Current maturities of long-term debt. Companies often have a share of long-term debt that is due in the current year. 5. Statement presentation and analysis. Presentation. Current liabilities are the first category under liabilities on the balance sheet. Analysis. Use of current and non-current classification makes it possible to analyze a company liquid. B. Contingent liabilities. Household companies report contingent liabilities. They use the following codes. 1. If the contingent is probable and the amount can be reasonably estimated. 2. If the contingent is only reasonably possible. 3. If the contingent is remote. 1. Recording a contingent liability. Product warranties are an example of a contingent liability that companies should record in the accounts. 2. Disclosure of contingent liabilities when it is probable that a company will incur a contingent liability, but it cannot reasonably estimate the amount, or when the contingent liability is only reasonably possible, only disclosure of the contingent is required. Payroll accounting. Payroll and related benefits often make a larger percentage of current liabilities. 1. Determining the payroll. Determining the payroll involves computing the 1. Gross earning through payroll deduction, and 3. Net pay. 2. Recording the payroll. Recording the payroll involves maintaining payroll department records, reconciling payroll expenses and liabilities, and recording payment of the payroll. Employer payroll taxes. Payroll tax expense for business result from the tax the governmental agency levy on employers. This tax 1. Fees, 2. Federal and employment tax, and 3. State employment tax. 4. Filing and remitting payroll taxation. Preparation of payroll tax return is the responsibility of the payroll department. The treasurer department makes the tax payment. Much of the information for the return is obtained for employee earnings record. 5. Internal control for payroll. Chapter 8 introduces internal control as applied to payroll. The objective of internal control are 1. To safeguard company assets against unauthorized payment of payroll, and 2. To ensure the accuracy and reliability of the accounting records pertaining to the payroll list. Irregularity often results if internal control is lacked. Example: Oke, terima kasih atas perhatian. Thank you for your attention.